It was rumored from Bloomberg reporting that Shell wanted to offload these assets because it was so expensive. It was going to be hard to find buyers. How did this deal come about, Ryan, and why now at this price?
Well, thank you, Alex. Appreciate the opportunity to chat with you today. It came as a bit of a surprise. I think Shell made a decision to put the assets on the market, and I got a call about the mid-year saying, would we be interested in taking a look at them? And it's consistent with our strategy, consistent with where we're at and what we're doing, contiguous, and with the acreage position that we've developed after the Concho transaction. So certainly we want to go take a look at it. And then ultimately, most importantly, it had to fit really three things within our company. It had to fit our financial framework, which we laid out pretty clearly to the market back in 2019, and it did that. Could we see it clearly that we could add value to it? And we can after the Concho transaction and bringing our two teams together. We see ways to add significant value to the transaction. And thirdly, it's got to make our company better. Mm-hmm. And that's what we outlined today in our press release. When you look at our 10-year plan, this is accretive to just about everything we look at in our plan, and it makes us a better company. So we were clearly very, very interested when it came to the market, and we're really, really pleased to be able to transact with Shell.
And you obviously clearly had the cash. I mean, you had a great balance sheet, oil at this price, you got a lot of free cash flow. The deal did come in higher on a per net acre basis and a per flowing barrel basis than your Concho deal. I appreciate that oil prices are up since your Concho deal, but some are saying that that is too high of a price. Maybe you paid a little bit too much. How did you come to the right valuation?
Well, that's what's great about our cost of supply framework inside our company, because it's agnostic to price. So to fit our framework, Alex, the all-in cost of supply needs to be below $50 a barrel WTI, and the future investments need to compete within our portfolio at a cost of supply less than $40 WTI. So we didn't evaluate it at today's prices. We looked at it to make sure it fits our cost of supply framework, and then we felt like we paid a fair value for the assets based on that cost of supply framework, which is all in below $50 WTI. So it really is agnostic to what the price is doing today. It represents our long-term mid-cycle view of prices, and we need to make sure it fits our framework about how we allocate capital at the highest level. And it does at this kind of a purchase price.
Yeah, so then on that, this is like a longer-term strategy question, Ryan, because something that Conoco does is you guys do things before the rest of the industry does. So when you guys were already sort of regulating your CapEx, you were paying out more buybacks and dividends, the rest of the industry was not. They were outspending their cash flow. Then when you kind of cut your payouts, you did it first before the industry. So the fact that you have to raise your CapEx and you bought two huge deals, what is that telling me about how you, Ryan, see the industry and a potential super cycle or a supply crunch coming up?
Well, I think we're pretty bullish on the next couple of years. We think the supply and the balance in the market, the restraint that the OPEC or OPEC Plus group has put into the system, the recovering demand that we see coming out of the world today post-COVID pandemic. We see the demand improving. We see probably getting back to pre-pandemic levels by the end of the fourth quarter into the first quarter of next year, and the market getting relatively balanced. And then there's been discipline, as you point out, on the U.S. and the E&P investors, which is what we've been following for the last 4 or 5 years. We think that's important. We still see that discipline. So we're pretty constructive on the price going forward. But in our kind of view, the world is going through an energy transition. There's going to be increased demand for the product as we go forward. So we want to be in the best basins and the lowest cost supply basins around the world, and that's what the Permian Basin represents. We've got a very stated strategy to be really, really driving the company and its portfolio to the lowest cost of supply so we can continue to meet the demand in a transitioning world. And that's going to be really important. We have what we call a triple mandate. We think that we have to meet that demand in a transitioning world. We have to do that reliably and affordably. Second, we have to make sure that we're getting adequate returns of and on that capital that we're spending so investors will invest in this business. And then we have to do it sustainably. We have to take care of our Scope 1 and Scope 2 emissions, the emissions we create as a business, to make sure that we're doing that in a Paris-aligned climate risk strategy. We were the first E&P company to come out with a climate risk strategy that was aligned to Paris. So we'll reduce our emissions. And in the announcement we made last night, we're increasing our target with our emission reductions plan associated with the combination of these assets.
Ryan, let me jump in. Good morning, it's Guy.
Good morning, Guy.
Can I take you back? Can I take you back to the point you just made about investors and how they'll be feeling about this deal? What do you say to, and I'm sure there are some, those investors that say, you know what, we'd rather have had the cash flow returned to us. That is why we're investing in this sector right now. That's why we're investing in ConocoPhillips. You've gone out and bought some acreage. We'd rather we had that money in our pocketbooks rather than you going out and spending it. What do you say to those investors?
Well, I'd say, this acquisition underpins our financial commitment to the market, and it delivers free cash flow. It's immediately accretive on all those kind of metrics: free cash flow yield, earnings. And so we're taking that money, we're investing it over the course of the next 10 years. We already showed how it's accretive to our 10-year plan. It delivers that and more back to the shareholders over that 10 years, and that's at $50 WTI prices. At today's prices, the shareholder gets a return and then some on its investment in half that time. So this is what we do. This is what we're really good at as a company. And I think investors should want us to be making these high-valued, accretive kinds of opportunities because it makes our plan better over the next 10 years. It makes us a much stronger company doing what we do really well.
Some investors may have looked at this deal and thought, hey, I thought these guys were focusing on Alaska rather than the Permian. Is this a zero-sum game? Is a deal in the Permian a deal kind of against what is happening with you guys and your acreage in Alaska?
No, Guy, this is, we strongly believe in a global diversified portfolio. It's one of the strengths of our company, and it's one of the differentiating attributes of our company relative to our E&P competitors and our peers. So it lowers the capital intensity by having these large legacy positions in places like Alaska, Norway, Canada, the Far East, Australia, Qatar. Those things just add to the capability of the company. They lower the decline rate of the company. They stabilize the company, less capital intensive kind of business, lower the decline rate. So we strongly believe in maintaining that global diversity, but we got to make sure that it's low cost of supply wherever we're at. And the things that we're doing up in Alaska complete favorably in the portfolio, whether it's Permian or our other Eagle Ford positions or any other opportunity we have around the world. That's the great thing about our cost of supply framework, is it makes sure we're doing the best things to get the best returns on the capital we're spending.
Ryan, real quick on Alaska, and you're not going to want to answer it, but what is your level of confidence that you get to do what you want to do in Alaska?
Well, we expect to do what we're wanting to go do, Alex. This is nothing new to us. This has been our 45-year track record in Alaska. We know there's some differences of opinion, but when you look at the operations that ConocoPhillips operate in Alaska, we've been there for nearly 50 years. We do it right in Alaska. And it's really important to the state. All our stakeholders are supportive and behind what we're doing up there. A federal judge on the Willow project asked a few questions. There's remedies, there's solutions to those, and we're working through those. And we expect to work through those in a way that will satisfy the questions that the judge has and make for even a more robust permitting process that we've already been through on the projects that we're developing up there. And I remind people that we've got a project coming on at the end of this year called GMT2 in Alaska. We've reinstituted a number of rigs that are drilling up there, and we're still operating and still investing capital up there that's very, very competitive in the portfolio.
Before we let you go, I want to take you back to the Shell acquisition. On the call and in the press release, you made some pretty very specific targets that you said a 15% growth rate, a growth target for the Shell assets in less than a year. You also upped your emissions for Scope 1 and Scope 2, the intensity reduction target as well. What are you going to do that's so different than what Shell did?
Well, I think it's going to apply the efficiencies, the technology, the learnings of our companies. We brought the Concho, and you mentioned that in your opening remarks, brought Concho and ConocoPhillips together. We've created a very efficient machine in the Permian and across our whole lower 48 operations. And we're really proud of what they're doing. They're really attacking the technology and the efficiency side. We already see some ways that we can improve upon what Shell was doing. And Shell was doing a good job out there. They just didn't have the size, scale, and scope that we do. And we've got a much larger position. We're able to bring some of those learnings across the Eagle Ford, the Bakken, and what we're doing in the Permian together to make the assets much better. And that's an important driver in this acquisition, is we know how, with our commercial acumen and the technology that we're deploying, we know how to make the assets even better. And that's what's exciting to us.
Final question from me. We're not going to quite let you go just yet, Ryan. The Qatar North Field, does this deal have any impact on your aspirations there?
No, Guy. I think we're well placed in Qatar. We've been there for a long time. We're a participant in one of the large mega trains at Ras Laffan, and we're competing with a few other companies to secure a position in the expansion project as well. So no impact at all. Again, it goes to sort of the global diversification of the company. We invented some of the LNG processes 50 years ago up in Alaska. We have our own proprietary technology. We know the LNG business really well. We know the customers really well, and we're pretty bullish on LNG markets going forward over the next 20 and 30 years. So it makes an amount of sense for us to be in the middle of that. But again, whatever we do there has to fit our framework. And if it fits our framework, we're happy to move forward very aggressively.